back in the day when I was a sell-side analyst, you went to Boston 3-4 times a year to shill for your II votes, which I got, by the way. I owned that town for a long time. One of the places you went was Wellington Management. I mean, solid, old money, crusty New York money. That's where you went. Some smart people there. I never got off on the fixed income floor. I went straight to the equity floor.
Elevator didn't stop there.
Yeah, no, that's too much math. Brij Khurana joins us. He's a senior managing director, and he's a fixed income portfolio manager at Wellington Management. Hey, Brij, is our Federal Reserve going to cut interest rates in November? Because I'm looking at some of this economic data, even like the industrial production numbers that came out today, pretty solid across the board. What do you think our Fed's going to do?
Thanks for having me back. Yeah, I do think they are going to cut about another 25 basis points in November. You know, why has the Fed changed its rhetoric to focus so much on the unemployment rate from focusing on inflation? I really think it comes from their change in view. They have this line that they've been repeating quite often, that the labor market is not the source of the inflation in the economy. And that is their biggest fear, because that's what the 1970s was about, the wage price spiral. And now they don't believe, and they're right about that, I think, that the leads speak to the labor market not being the reason we have inflation in the economy, and that means that they can go back to their pre-COVID policy of targeting the neutral rate for the economy, which they think is about 3%. That's the level where they don't think policy is expansionary, they don't think it's contractionary, and they're looking at the economy and they say, look, interest rates are at 5%, we think 3% is neutral, we have a lot of room to cut, and we're still in restrictive territory. So I think they're going to continue along this path with that 25 basis point cut.
For a neophyte like myself who has heard of R-star but just doesn't understand the intricacies of it, how difficult is it for them to target this, and how much disagreement is there among policymakers on that committee about what it is?
So it's very hard to know. You only know when you're either
and not
above
in
it
real
or below
time.
it, right? You don't know in real time. What you can do is you can look at their estimates. So you go to that dot plot that we all talk about, look at where their long-term dot is. It's around 3%. And there's actually a lot of, that's the spot where there's most consensus on. So they think it's around 3%. But I don't think that really matters whether or not it's 3, 3.5, or 2.5. The point is that they're at 5, and they're dealing with an inflation story which is less pronounced than it was 2 years ago. And so they're basically saying, okay, maybe it's 3.5. Let's see what the economy looks like when we get down to that 3.5 level. If it's still accelerating at that point, then yes, maybe the neutral rate is higher. But we just know that we're much higher than that at this point.
All right, so if I'm in the fixed income business today, I don't know. I don't have to be a rock star. I can sit in a 2-year treasury and get.
You could get off on that floor.
I can get off on that floor and say, "Hey, kids, I'm long the 2-year treasury. I'm clipping a 4.05% coupon. Should I just do that, or should I take some credit risk?"
Yeah, I mean, I do think that bonds are attractive. I do think that when you look at credit spreads, they are quite tight right now. So investment grade spreads, looking at the Bloomberg indices, less than 100 basis points, high yield spreads below 300 basis points. That is not a lot of compensation for the risks that are out there. I mean, we are in the first quintile of spreads, and historically over the next 3 to 4 years, that does mean negative excess returns for credit sectors. And I do think we actually are seeing defaults and the distressed exchange ratio, which is basically when your bonds get primed by other borrowers. And so, we're seeing that increase. It's around 5.6% right now, which is actually quite high. And so, relative to defaults and recovery rates, we don't really feel you're being compensated very handsomely right now in credit markets.
Let me go negative here and say, were things to take a turn, were we to get this kind of phantom deep downturn or recession, how well equipped is the Federal Reserve to deal with that at this point in time? When you look at sort of the policies that they've put in place, certainly the amount of assets that they bought as well, that they're beginning to unwind. Should we be worried about what tools remain in the Fed's toolkit?
I mean, I think given where the starting point of policy rates is, they have a lot of tools. I do think that this cycle is going to be different if we do enter that downturn, in that I think as much as they're going to continue to use interest rates as the primary tool to which they change monetary policy, I think they're going to be loath to use the balance sheet as aggressively as they did after COVID. And so, I think if there is a problem in the treasury market, I do think they'll come in and buy bonds like they did in March 2020. But I think they were roundly criticized for buying so many agency mortgage-backed securities after COVID and thereafter. And so I don't think they're going to be doing that the next round. And I do think that is an important point, though. We have been in this Goldilocks type environment, and we don't think about what's coming up. But if we do enter a recession, the Fed is not going to be as aggressive as we've seen after the GFC or after COVID. And so, credit investors should keep that in mind, that the tail is not as clipped as you may think.
September was I think, the biggest month for investment grade new issuance on record. All the banks have been flooding into the market with new issues. If I'm a bond salesman at like Morgan Stanley or JP Morgan, are you guys at the top of my call list? Do you buy new issue stuff? I mean, you're Wellington. Or do I just go to all the hedge funds to buy this new stuff?
I mean, we're definitely a large asset manager, and so we certainly, do buy the IG corporate market. I do think it is interesting that we thought we kind of entered this year thinking that net issuance, so this is not only issuance, but it's also versus redemptions,
right,
was going to be on the lighter side. We were kind of thinking 400 to 500 billion, and that was going to be kind of a tailwind to credit markets because you just have less supply than we've seen over the last few years. I've just been almost surprised by how much issuance we've seen. I think gross is 1.2, 1.3 trillion, and even net issuance is kind of 600 billion-ish. And so it definitely, I've been surprised by two things. One, the amount of supply we've seen in the investment grade corporate market, but just kind of the ravenous nature with which everyone's taking it down. Its supply almost causes spreads to tighten, not widen.
Every book I see for these things, I don't care if it's Purina Cat Chow or JP Morgan, these things are oversubscribed multiple times in a bond market. I mean, I expect that from one of my IPOs back in the day because I was a great syndicate salesman. But fixed investment grade debt?
Yeah, it is interesting. I think what people are really focusing on is the high level of yields compared to the level of spreads.
Yep.
That's what we constantly hear. Well, spreads are tight, but yields are high on a long-term basis. I do think that people are very focused on income right now, in fixed income focus on the income part. I don't think people should really forget about the total return nature of fixed income, though, as well. And I think we're talking a lot about the election these days, as I'm sure you all are. And I think in this, the market's really pricing in a large percentage of some kind of sweep. I think we should also think about the other tail, though. What if we get divided government? And in a divided government, you get that fiscal tightening, you get perhaps slowing economic growth than we've had over the last few years, and that's an environment where bond yields could actually fall a lot more than people think. And so you don't want to also forget the other side where bond yields could fall.
Let me ask you one other question, kind of tied to the election, and we've heard Donald Trump say he'd like to advise the Fed chair, give him his opinion on whether rates should go up or down. Going into the interview that he did with our editor-in-chief, John Micklethwaite, Betsy Stevenson was making a very strong case that shouldn't happen, that Fed independence is so important. I want to get your perspective, sort of the market perspective on that. I think part of what she was conveying in her comments was the bond market in this country is propped up and fortified by the fact that the Fed has independence. Are folks like you thinking about this, worried about this? How much do you give credence to what the former president has been saying about taking on that kind of new advisory role were to be reelected?
Yeah, I do think central independence is extremely important, and bond markets are good at pricing that in. And so I think one of the reasons we have seen term premium rise with how the election might play out is because when you have political influence on a central bank, you should get compensated for that risk. And so, and particularly at the back end of the curve. And so I think you're starting to see that materialize, that if this rhetoric continues and actual actions take place regarding it, you should be compensated for more yield as a result of that, almost that going back and forth on different policies and what's the president saying versus what the Fed's doing. And so I do think that term premium has increased, and that's largely as a result of that.